In this video we're going to look at the balance of payments and exchange rates and see how the two are linked and also what issues arise when exchange rates move. Now this is one of a series of short videos on this topic and it's well worthwhile checking out the other videos as well. So first of all, the balance of payments records a country's international transactions involving the payment or receipt of foreign exchange. That's what the balance of payments is. It's simply a record of, if you like, imports and exports. It's a record of trading internationally. And it's made up from two accounts. The current account, which records the international transactions relating to import and exports of goods and services. So when we think of the balance of payments, we normally think of goods imported from another country or exports to another country. That's the current account. That's one of the accounts. The second one is the capital account. And this records international transactions in assets. An asset is any one of the forms in which wealth can be held, such as money, equities and bonds. And sometimes money, equities or bonds or whatever, they can flow from country to country. This is recorded in the capital account. So there are two accounts. The current account, which records imports and exports, and the capital account, which records monetary flows. The balance of payments is based on the principle of double entry bookkeeping. Now, double entry bookkeeping means that every credit has a debit, so that every time there's an entry in one of the accounts, there's a corresponding entry in another account, such that the two cancel out. So every debit has a credit. That's what the accountants tend to say, apparently. This means that every international transaction automatically enters the balance of payments twice, once as a credit and once as a debit. So if I buy an imported car, let's say, or if I'm responsible for the importation of a car, I receive the car. That's recorded in the current account. But then I have to pay for the car. And the money I pay for the car must be perhaps converted into another currency and paid overseas to the people who produce the car. That's a part of the capital account. So the value of what I receive in the current account matches the value that was converted in the capital account. So the two sides balance. Double entry bookkeeping is used because there are always two sides to every exchange. For example, if a UK citizen buys a good from overseas, they must pay for it, like I just said. So there's two sides to every transaction. One side, I received the car. On the other side, I had to pay for the car. And what I paid for the car was, in a sense, repatriated or sent back to the country to pay for the product I received. I received the car, and the producer in the other country received what I paid. Obviously, we have to look at commissions and who gets what and the car dealer and import agents and so on. But the principle is that I've received the car valued at so much and I had to pay for it. So there's two sides to the transaction. The UK imports of goods from overseas, which is recorded as a debit on the current account, but it has exported assets, i.e. money, overseas, which is recorded as a credit on the capital account. So in terms of the accountancy relationships here, imports are debits on the current account and credits on the capital account. And the two sides balance. It's double entry bookkeeping. The two sides are equal. Due to the principle of double entry bookkeeping, it must always be the case that the current and capital counts are of equal and opposite size. When they're added together, they come to zero. They equal zero when they're added together. So the capital account has the same value as the current account, but just the opposite way around. So when you add the two together, you get to zero. The balance of payments are said to be in disequilibrium when private sector, or if you like, autonomous transactions, these are transactions that just happen. The private sector make transactions. We buy the car, or we buy raw materials, or we buy imports of some sort. That's the private sector. We call them autonomous transactions. They're transactions just simply caused by the private sector. They're importing something, let's say. And it's when there's a disequilibrium, whenever the private sector autonomous transactions do not balance. In other words, what we export and what we import don't balance. If we exported exactly the same value as what we imported, the balance of payments would be in equilibrium. But sometimes, and most times, we don't export the same value as we import. Sometimes we export more and sometimes less than the imports. So we have government or accommodating transactions which offset this imbalance. And that's how we know the balance of payments is in equilibrium or not. It's the extent to which, let's say, the Bank of England, in the case of the UK, the Bank of England must enter the market and pay for the difference. Now, exchange rate determination. Well, exchange rates are determined in the foreign exchange market and adjust so that the demand and supply for currency are equal to each other. So exchange rates are determined in the foreign exchange market. That's where they originate. And it's a supply and demand relationship, very similar to what we'd meet in microeconomics. Let's take a UK exporter, and let's say the exporter sells £1,000 worth of goods in the United States. So we'll take a simple example where we're taking it from a UK perspective. This could be from any country's perspective. You just change the words UK and US to whatever you want. But let's say, just for argument's sake, we're dealing here with the UK and they export £1,000 worth of goods to the United States. If the exchange rate is $2 to the pound, the goods will sell for $2,000 in America. That's if the exchange rate is $2 to the pound. If the exchange rate falls to $1 to the pound, the goods will fall in price in the US to $1,000. So the exchange rate makes a big difference on the price of goods that are traded internationally. The exchange rate is very important in determining the price of goods internationally. So here is a situation where the exchange rate, let's say, has fallen from $2 to the pound to $1 to the pound, and we can see what's happened to the price of goods in America as a consequence. Now if we look at that diagrammatically, at $2 to the pound, the top figure on the diagram, $2 to the pound, there was X1 exported. And when the exchange rate fell to $1 to the pound, goods in America became cheaper, the same goods, but they were just a lot cheaper. That means the chances are there will be more demand for the goods in America because they're much cheaper, therefore more exports. So exports will rise to X2. We call exports X, by the way. So at the high exchange rate, $2 to the pound, we have X1, and at the low exchange rate, $1 to the pound, we have X2. More exports at the lower exchange rate. Now let's look at the situation where we have a UK importer, and the UK importer buys $1,000 worth of goods from America. Now, if the exchange rate is $2 to the pound, the goods will cost £500. If the exchange rate falls to $1 to the pound, the goods will cost £1,000. So a fall in the exchange rate here has made imports a lot more expensive. The example we've got here, it's double the price of the imports. So the exchange rate influences the price of imports. So at $2 to the pound, we paid £500 for the items, both of them from America, at £500. And they come to the UK for £500. And the amount that we import at that is M2 on the diagram. M2. Now, if the exchange rate falls to $1 to the pound, we pay a lot more. We pay £1,000. That means American products are very expensive in the UK, so we buy less of them. So imports fall to M1. So as the exchange rate fell, imports fell. Now, if we think back to the previous diagram, we have a situation here of really supply and demand. An exchange rate of $2 to the pound, imports are greater than exports. An excess of imports over exports must be financed. We have more imports than exports, well, they have to be paid for. The difference between what we generate from exports versus what we pay for imports, that difference must be paid for. The central bank in the UK, known as the Bank of England, will sell pounds and buy dollars. So the Bank of England must make up the difference. If imports are more than exports, then they must sell pounds and buy the dollars. So they're selling the pounds, which will force the price of the pound down, and they're buying dollars, which of course will push the price of the dollar up. This will cause the price of the pound to fall relative to the dollar. So at, say, $2 to the pound, we have imports greater than exports. We have M1, which is greater than X1. And there will be downward pressure on the exchange rate because the Bank of England will sell pounds, forcing the exchange rate downwards, and it'll buy dollars, which will also force the exchange rate downwards. So what will happen then is that exports, as the exchange rate falls, exports will increase because exports are cheaper, and as the exchange rate falls, imports will decrease, moving us towards the equilibrium. So it is just a supply and demand relationship. A fall in the exchange rate will encourage exports and reduce imports. That's the point. And that's our diagram. It is just basically supply and demand. It's what microeconomists sometimes call a Marshallian cross, named after Alfred Marshall, supply and demand. And it leads to an equilibrium in the exchange rate. If imports exceed exports, the exchange rate will fall. This will cause exports to increase and imports to fall. So a fall in the exchange rates means that imports become more expensive, there will be less imports. A fall in the exchange rate means that exports become cheaper, so there will be more exports. The process will only stop when imports equals exports and an equilibrium exchange rate is reached. So we have the equilibrium exchange rate, ER bar, bar on top. So the exchange rate is at equilibrium. And if you trace that line downwards, you see that X is equal to M on the horizontal axis. So exports equals imports. So if this market is free to move, the balance of payments will be roughly always in equilibrium because the exchange rate will move up and downwards to compensate. So the exchange rate sometimes will be high or sometimes will be low depending on conditions, and but imports and exports should always be balanced. Maybe sometimes slight movements off, but it'll adjust to it. The market adjusts. It's a normal market relationship. If exports exceed imports, the exchange rate will rise. There'll be an increased demand for pounds. So if exports are more than imports, then foreign central banks will be looking for, let's say, pounds, and there'll be an increased demand for the pound. This will cause exports to fall and imports to increase. The process will stop when M equals X, when imports equals exports, and an equilibrium exchange rate is reached again. So if we look at the diagram there, if we start with $1 to the pound, we can see that exports are more than imports. That means that the foreign central banks have to buy pounds. They're, in other words, increasing the demand for pounds, so the exchange rate of the pound will start to rise. And also, the Bank of England will recognise that there is. We'll see from what's happening in the market. We'll see that exports are greater than imports. So they will make available their currency, and that means that the price of the exchange rate will rise because foreign central banks are buying the pound. So the whole process will stop when exports equals imports, when there's an equilibrium exchange rate. Now, I mentioned this term autonomous transactions earlier. Autonomous transactions are simply transactions that arise for whatever reason, for the fact that there is a preference amongst, let's say, consumers for particular types of goods. It's autonomous. It just simply happens. It's not a part of any wider system. It's just something that occurs. We want to import certain products, or foreigners want to buy particular, say, British products or UK products. So one type of autonomous demand for sterling could be UK exports. Let's say just the Americans want UK exports. It just happens. American consumers suddenly like UK exports and they want to buy more of them. That's an autonomous demand for sterling, because they want to buy the UK exports. They must pay for them, and they must pay for them by creating a demand for sterling. They must buy the pound and pay for what they're importing. Capital inflows, when companies overseas or governments overseas wish to invest in London, let's say, into the UK, they must buy pounds. It's an autonomous demand for sterling. They buy the pounds, they convert their currency into pounds and make their investment. So there's an autonomous demand for sterling. Now, we have, in a sense, been talking about flexible exchange rates throughout here. We talked about supply and demand and how the exchange rate would adjust to bring about an equilibrium in the balance of payments. So we are talking about flexible exchange rates. So this is where the government does not seek to affect the value of the exchange rate, but instead allows the exchange rate to fluctuate whenever there is a shift in the demand and or supply curves. So in other words, the government stays out of it. The central bank stays out. It allows the market to work. the exchange rates are flexible. Sometimes the exchange rate rises, sometimes it falls, and depending on the upward movement and downward movement, there's adjustments in the amount that's demanded or imported. But in a sense, the market works it out. There is no intervention. There's nobody controlling it. It's the market. It's all of the importers and all of the exporters and all of the people who demand different currencies and so on. All of those together are influencing the exchange rate. If the exchange rate appreciates, if it goes upwards, when the exchange rate is flexible and it increases in value, so more dollars can be bought per pound. So if, the exchange rate appreciates when the exchange rate is flexible and increases in value. So when the exchange rate is flexible and people overseas buy British goods, buy British exports, then the exchange rate will rise. The exchange rate depreciates when the exchange rate is flexible and falls in value. So fewer dollars, say, can be bought per pound. That's a fall in the exchange rate. If we were getting $2 to the pound at one stage and suddenly we're getting $1 to the pound, the exchange rate has fallen. The pound is able to buy less dollars. So of course, if we were going on holidays to America from the UK, at one stage we're getting $2 to every pound. That's very good. If it falls to $1 to the pound, that's not so good. That's not good at all. I've taken figures here, by the way, quite exaggerated figures. We normally don't encounter big movements like the ones I'm talking about. I'm just doing that to illustrate. Now, the main factors affecting the exchange rates. Well, inflation rates. If the UK has a higher inflation rate than, say, the US, then everything else equal, UK goods will become less competitive. And also the UK will import more and export less goods and services. This increases the supply of and reduces the demand for sterling. As a result, the exchange rate will depreciate. So if the UK has a high inflation rate, higher say than America, then we'd expect the Americans to buy less British goods because British goods are becoming more expensive. And if they buy less, there's less demand for exports from the UK. So the exchange rate will fall. Income levels are also important in determining the exchange rates. When national income rises, everything else being equal, the demand for goods and services will rise. But as income levels rise, we may also buy more imports. So imports may increase. And this increases the supply of sterling, and again the exchange rate depreciates. So if income levels rise, we may import more. As we import more, the exchange rate will alter. Interest rates. This is dealt with in another video under a topic called arbitrage, but quite simply, interest rates are important in determining the exchange rate. If investors who have money available for investment overseas, if investors, let's say in New York, can get a higher return in London for their investment, for their money, they will move their money to London. So interest rates will determine movements of money, which will, of course, determine the exchange rate. So let's say the government in London wants the exchange rate to be higher than it is. It may increase the rate of interest or ask the banking system to see if it can increase the rate of interest. Increasing the rate of interest means more money will flow into London because that money will get a higher return than, say, in New York or than in Paris or in Tokyo or wherever. So more money would flow into London, creating a greater demand for sterling, greater demand for the pound, which will mean the exchange rate would rise. Expectations are also important. If speculators expect that the dollar to the pound exchange rate will appreciate, they will seek to buy sterling. So sometimes people buy the currency in the expectation of making a capital gain in the future, if their expectations are borne out. If they expect to be able to sell pounds in the future at a higher price, so they will make a capital gain. So let's say people believe that the exchange rates will appreciate in the future. They buy the currency now and hold it, wait for it to appreciate, and then sell it and make a capital gain. Of course, it's almost a self-fulfilling prophecy, this one. If people expect the exchange rate to rise in the future and they buy the currency now, they're actually increasing the demand for the currency, which will move the currency upwards. And then, of course, when it moves upwards, they will sell the currency and make a capital gain. But the very fact that they expected the currency to rise has caused it to rise, because they have actually bought the currency. They bought the currency in the expectations of a capital gain. The increase in demand for sterling will cause the exchange rate to appreciate. So, as I said, it is to some extent a self-fulfilling prophecy. Now also we need to consider fixed exchange rates. This is where governments seek to maintain the value of an exchange rate. So it actively offsets, or we sometimes say accommodates, any fluctuations in the demand and or supply of the currency. So the government intervenes in the market through the central bank, intervenes to keep the exchange rate fixed. Now, why would we want to do that? Well, back in 1944, the Bretton Woods Agreement was put in place, which required many countries, the ones who signed up to it, to fix their currencies rigidly against each other. Well, there was a small degree of latitude. They could fluctuate by a very small margin. But essentially, the currencies were fixed one against the other. And the reason for that was it was believed that this would encourage world trade. It would reduce uncertainty, the uncertainty caused by exchange rate fluctuations, and therefore there would be more international trade. There were problems with fixed exchange rates, and eventually the system did break down in the 1970s. But it really came under stress throughout the 1960s, so it didn't last very long. In fact, probably the best part of 20 odd years before it started to come apart. It requires constant intervention by governments, and it requires lots of reserves on the part of individual governments. They must hold the reserves to be able to intervene. If their currency is starting to move downwards, they must move in and buy their own currency by using foreign exchange. But of course that means they must have the foreign exchange available to do it. So it does require a lot of reserves on the part of central banks to be able to maintain the fixed exchange rates. And that was part of the problem. Many central banks simply didn't have the reserves to be able to do this. So fixed exchange rates were seen as a way of promoting international trade. So the exchange is revalued when the government allows the target exchange rate to rise. So more dollars can now be bought per pound, let's say. So sometimes when there was what's known as a fundamental disequilibrium, the rate was wrong, and there was a constant problem because the government was constantly required to intervene in the market to try and fix the difference between imports and exports. At that stage, it was termed a fundamental disequilibrium, and in that case, the government could, with permission from the others who signed the agreement, it could move the exchange rate from one level to another. It could be devalued or it could be revalued. Depends on what the problem was. And then they hoped that by moving the par level, moving the fixed exchange rate to a new level, that would fix the problem in that country. There would be no more excess of imports over exports or of exports over imports. It would balance. The main ways in which governments seek to maintain fixed exchange rates, well, buying and selling foreign exchange, interest rates, and trade restrictions. Well, if there were fixed exchange rates, then buying and selling foreign exchange, that may be an option if each central bank had enough reserves to enable it to buy and sell foreign exchange. But sometimes central banks didn't have enough, and that's where a real problem could arise. They could use interest rates and try to get this arbitrage movement that I talked about earlier. So let's say a country was experiencing high imports, therefore there was downward pressure on its currency, but it needed to fix the rate was fixed, so it couldn't allow the rate to fall, even though it was importing a lot more than it was exporting in value terms. So what it could do is increase its rate of interest. And hopefully foreign investors would then put money in to get to reap the higher rate of interest. It was tricky, however, because sometimes investors would think, well, the currency is going to be devalued because the exchange rate is wrong. It's not fixed at the right level. So why put the money into a currency if it's going to be devalued? Because they're going to get less back. So interest rates may not be an effective way of doing it. Trade restrictions may be a way of doing it. Stopping imports, having tariffs and so on. But of course that flies in the face of the whole idea. The whole idea was to encourage international trade, not to restrict it. That's why the currencies were fixed against each other, one to one against each other. So having trade restrictions is flying in the face of the whole idea. Autonomous demands for sterling. Well, UK exports, that would be demand for sterling. Capital inflows flowing into the country, as I said earlier. Now, managed exchange rates. Well, this is where a government allows the exchange rate to fluctuate within set limits. So it's managed. Sometimes the government can't hold the absolute fixed rate. And when the Bretton Woods system broke down in the 1970s, they moved to managed exchange rates. Many countries tried to hold particular rates, but sometimes they would allow the rate to move upwards or downwards according to conditions. So it was allowed to float, but the central banks managed the rate at which it floated upwards or floated downwards. So it didn't float downwards like a brick. It just floated downwards according to what the policy of the central bank and the government was. So there are fixed versus flexible exchange rates. Well, arguments in favour of fixed exchange rates. Well, it reduces volatility and uncertainty, which promotes international trade. That was the stated objective of the Bretton Woods system. That there would be more certainty in the system, there would be less uncertainty, if you like, and therefore there would be more international trade. There would also be increased financial discipline and enhanced credibility for anti-inflationary policies. So greater financial discipline, because governments had to hold the exchange rate fixed. And that meant they had to make sure that the rest of their economic policies were such that the exchange rate could be held fixed. So it forced discipline on them in terms of overall economic policy. And automatic stabilization of monetary demand stocks. In other words, the amount that the central banks held would have to be adjusted to make sure that there was enough available to support the currency if it was required. Arguments against the use of fixed exchange rates. Well, the central banks had to hold large reserves of foreign exchange. And of course, there was an opportunity cost associated with that, that the amounts that were held could have been used for some other purpose, for building roads or hospitals or schools or doing something else. So it was costly to hold foreign exchange reserves. It could lead to trade restrictions if the country was experiencing excessive imports over exports on a chronic basis, on a long-term basis. Then it may be that the government would be forced to impose trade restrictions, put up tariff barriers or block imports of certain items. Or, of course, this was in stark contrast to what the original objective was, which was to promote international trade. And now the government may be restricting international trade to try and hold the exchange rate. It tends to reinforce real demand shocks. The real demand shock, when demand in the economy varies for whatever reason, let's say seasonal demands even, say a seasonal demand, a Christmas one, then people want to buy more goods. Well, part of the buying process may be to buy imports. And that may lead to more pressure being encountered by the central bank to try and hold the exchange rate. So the fixed exchange rate system was confusing and contradictory in some ways, and was also very expensive to hold. So for that reason, it started to come apart. Ironically, some countries decided on fixing their exchange rates totally. For example, in the European Union now, many countries have fixed their exchange rates rigidly, one against the other. So much so that they've now got a single currency, the euro. So many currencies now cease to exist. There's no French franc or Greek drachma or Italian lira, German Deutschmark. These have become a single. This is because their currencies are absolutely fixed, one against the other. So in a sense, they cease to exist. It's now become one currency because they're absolutely rigidly fixed together. So even though we can see problems here with fixed exchange rates, some countries have gone ahead and fixed their currencies together. So they don't have flexibility. The balance of these arguments depend on the nature of the economy, and in particular how open the economy is to international trade and the type of shocks it typically faces. So as to whether it should be fixed or flexible, really it depends on the nature of the economy. Some economies are very small and they tend to link with bigger economies and have single currency. That was the case of the Republic of Ireland and the UK from the foundation of the Irish state in the 1920s to about the 1970s, into the 1970s. So they had a small economy linked to a large economy, and it was a fixed exchange rate. In fact, it was one-to-one exchange rate. The more open an economy, the more exposed to real demand shocks, the stronger the arguments in favour of flexible exchange rates. So flexible exchange rates seem to be very important when the economies are open. As in the case of, say, the UK at the moment, it's a very open economy. And the people want it to be open economy and the governments want it to be an open economy. And that means the exchange rate is flexible. So people going on holidays will have to buy their currency at a particular exchange rate, and perhaps next week the exchange rate will be different. They may have lost or they may have won or gained as a consequence of buying in a particular time period. But the exchange rate is flexible. So these are some of the topics we need to look into when we consider exchange rates. That's about all we're going to deal with in this session. So we're going to leave it at that and say thank you for watching.